I think this is a good entry point, the Q2, but I think the one theme I would just say is that the U.S. economy is slowing down. And the reason it's slowing down is because we were spending too much money at the governmental level. The U.S. fiscal deficit last year was 6.5% of GDP. I mean, that's like a crisis number for any other country. And so it's not in the headlines, and the administration's not really talking about it, but all the different things, DOGE, tariffs, and everything, add up to slower growth, which is weaker equities and a weaker dollar.
So does that mean that other markets should continue to take preference over U.S. markets? We've seen European equities outperform U.S. markets year to date. All the trade got upended, obviously, since April 2nd, but we're now seeing that trade come back into the fold here. Do you think that outperformance is sustainable?
Yeah, I mean, we really like to look at multi-year trends. I do think this was an inflection point for Germany to do fiscal stimulus, right? I mean, they, for years, have been underspending in a way, and I think whether it's on defense or other items, this is a multi-year trend, and I think that we should be shifting away from U.S. equities.
In terms of the dangers of owning US assets now, we saw that in stark relief, of course, with the volatility we've seen in the bond market and to a certain degree in the currency market as well. Even if US equities looked fair value now, and there's a big question about whether they are as well, is the ownership of US assets become a lot more dangerous across the board now because of this oscillating policy?
I mean, I don't really think that I think it's a cyclical, not some kind of structural problem with the U.S. I think people tend to overlay a lot of their own political views on the style of our current American president, but we have to bring our budget deficit down. And so it's going to be, I call it the fiscal reckoning. It's going to be tough. But I do think that if all of this looks at a slowdown in our economy in the second half of this year, whether it's a light recession or a big slowdown, equities will price that in this quarter. And so, time to nibble. And because there's bad news, we haven't seen bad unemployment numbers yet, right? And so there's more bad news to come.
Yeah, and I fully take on board that people overlay their own political views and then extrapolate what they think is going on. But there is no doubt about it that the US has fired a warning shot about its position in the world, about how it sees reshoring, homeshoring, how it sees isolationism politically and geopolitically in many ways. That's going to encourage a lot of people to just hold fire on US investment, isn't it?
Yeah, well, listen, I think it's affecting a lot of sectors around the world, right? Here in Europe, I would say that the administration obviously is causing an increase in defense spending, and we offer ETFs. We have a defense ETF. But I also think
there is a structural change there in just that one sector you mentioned, from all the massive, Lockheed Martin, Boeing, what have you. There is a very strong reason why you wouldn't be necessarily owning those stocks if the US isn't going to be making F-35s for an international audience so much anymore.
We can't afford it. The United States can't afford it, right? And I think the second thing this is highlighting, this is a long-term trend. In 10 years, the Indian economy is supposed to be the size of continental Europe. So you have 4 big mega consumer markets in the world, the US, Europe, China, and India. And so what Trump is highlighting that I think is underappreciated is the frictions within those mega economies. And I think there's going to be more pressure on Europe, right, to get capital markets reform going. You see this even in Canada, where they have the provinces tax each other. So I think that's the longer term trend.